I wanted to make something that's more like Ethereum. Like if you want to validate on Ethereum, you don't call up Vitalik and tell him, yo, I want to be a validator. There's some rules and specifications for anybody to be a validator. And if you follow those rules that are in a smart contract, then you get to interact with Ethereum as a validator. Well, it's the same for us, right? There are these rules basically commoditizing the idea of a yield generator. And as long as you adhere to those, you get to generate yield for us.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic from 4RC. Today's show spotlights one of Ethereum and MegaETH's biggest stablecoin protocols in development to programmatically outsource yield generation called CAP. In this episode, we speak with the founder of CAP about how this promising new design aims to build the Uber of yield-bearing stablecoin generation. But before we do, just a quick word from our sponsors who make the Edge Podcast possible. If you've ever wondered what financial freedom looks like in the age of AI, meet Newton, a smart, secure way to empower AI agents to work for you without giving them custody of your assets, for a world beyond interfaces, built for autonomous finance within your own tailor-made set of guardrails. Follow Magic Newton on X and get ready to try Newton soon. This episode is brought to you by SKALE, the next evolution in Layer 1 blockchains with a gas-free, invisible UX, instant finality, and robust security. SKALE allows for limitless scalability and has already saved its 50 million users over $11 billion in gas fees. Visit scale.space today and follow their journey on X at SKALE Network. Hey folks, I wanted to tell you a bit about our sponsor, PYTH Oracles, your go-to source for smarter data to power smarter contracts. PYTH delivers real-time market data for crypto, equities, FX, and commodities to over 80 blockchains. With 120 plus major market participants like Jane Street, Binance, and CBOE, PYTH ensures secure, low-latency feeds trusted by 430 DeFi apps. You can learn more about PYTH by going to pyth.network. And thanks to the PYTH community for supporting us here at the Edge Podcast and Edge newsletter. Overwhelmed trying to manage your crypto and DeFi investments? Meet iYIELD, a free financial planning tool for crypto natives and yield farmers. iYIELD's dashboard compares returns from your DeFi positions side by side, providing clarity to help you make better decisions. iYIELD supports a growing list of over 16,000 tokens and 40 of the top DeFi and staking protocols across 17 blockchains, including Ethereum L2s. The best part is that iYIELD is 100% free, anonymous, and there are no ads. Check out iYIELD.com today to take control of your financial future. Launching your blockchain in months? That's so 2020. Launch your network in minutes with TANSSI infrastructure. Restaked security through SYMBIOTIC, plus full customization just a few clicks away. It's 2025. Build smarter, scale faster. Visit tanssi.network to get started. Hey folks, I want to tell you a bit about our sponsor, HOURGLASS, the protocol unlocking liquidity for time-bound tokens. With HOURGLASS Boost, you can time boost your assets and earn time-bound tokens that maximize your yield. Alternatively, HOURGLASS also enables leveraged airdrop farming, where you can get over 150x leverage and 10% more points than anywhere else in DeFi. Plus, thanks to their slippage-free market design, you can secure bigger airdrops at better prices. To learn more about HOURGLASS, go to hourglass.com. All right, let's introduce Benjamin, the founder of CAP. Benjamin, welcome to the Edge Podcast. How are you doing?
Great. Thanks so much for having me, guys.
So our conversation today should take everyone from 0 to 1 on CAP. CAP is a stablecoin protocol for outsourcing yield generation programmatically. We're going to unpack what all of that means. It is a protocol that has gotten a lot of attention. I think it is synonymous with MegaETH. So if you listen to a previous episode that we did with MegaETH and you're excited about MegaETH, CAP is one of their flagship protocols in development. And so I would actually compare what CAP is doing for stablecoin yield generation to what Morpho did for the lending and borrowing markets. So if you understand a bit of that dynamic with Morpho and lending and borrowing, you should be so excited for what these guys are building. But let's go ahead and start with more about your background, Benjamin. So yeah, tell us a little bit more about, just what you've worked on previously with KeyDAO, and then would love to get into the origin of Cap Labs.
Yeah. So, well, again, thanks so much for having me. I've been doing a lot of DeFi stuff for a while. I think I started in like 2018, 2019, doing a lot of infrastructure. Actually, on Hedera Hashgraph, which is, everybody has to start somewhere. Probably not the hottest ecosystem today. And then, like you said, I met QDAO, which is the first cross-chain stablecoin. As we noted before the interview, like at the time, nobody was building outside of Ethereum in DeFi. There were a lot of like Goose Finance forks. Everybody was forking Unity to maybe Compound. It was getting forked and then hacked, right? Because all those forks were getting hacked as well. Reentrancy attacks, that's great. And a lot of the giants like Maker, Aave, Compound didn't want to go outside of Ethereum because they didn't think that there would be a multi-chain scenario. We knew from the beginning that that's like the future. And we saw that there was like a gap in the fungibility of stablecoins. If you bridged USDC from Ethereum to Solana to AVAX, that was a different version of USDC than if you went from Moonbeam to AVAX. And so we created what now looks like the OFT contract from Layer 0 to aggregate different bridge versions from different chains. And we were able to grow a lot. So at peak, we had 10, 20 times the user base of Maker, Liquidity, Mim, all combined. So we had a ton of users opening up CDPs with us because we were in chains where people could afford to use the blockchain.
Yeah, that's super interesting. And I think it's rare to actually talk to somebody that's been working in stable coins as long as you. There's probably only maybe a handful.
It used to be a boring subject.
Yeah. And that's actually kind of what I want to talk about now, because stable coins are on this, crazy ascent in, I'd say, mainstream popularity. I think we can all agree that, it's looking really bullish for stable coins right now. So I want to just zoom out a bit. You, I believe, co-wrote an article. It was in Stanford Blockchain Review. We'll probably reference this article a few times on this podcast, but it was excellent. We'll put this in the show notes, but you start to break down like what's happening in the stablecoin space, and there's kind of two types emerging. I mean, well, there's three, but we'll get to that. But there's these settlement for fiat and store of value that you call out. Can you kind of break down and unpack those two different types that we're seeing right now?
Yeah, I think if you look at what's happening today, it's all yield-bearing stablecoins. But looking back, fiat stablecoins and settlement stablecoins are the only ones that have succeeded. So by that I mean stablecoins that are easy to on and off ramp that people just see as money. And there's two. There's USDT and USDC. They're used for remittances. They're used for, payments. Even SpaceX uses them for their internal accounting. So they have plenty of PMF. And why? Because, well, you can go from fiat in a bank account in Germany, put it on the blockchain, send it to America, off-ramp it, and that's like super seamless. And you don't have to pay all the random fees and wait all these kind of like times that it would take you to do a wire, etc. Those are doing amazing. The way that's happening today is yield-bearing stablecoins. How do we make, okay, we already fine holding the dollar on chain, but how can we make yield for it? Because as we all know, there's a lot of inflation. And I think there's a lot of confusion around what these stablecoins are and how they generate yield. And it's the same amount of confusion I saw back in the Terra days, where people were just kind of like taking stablecoins based on the hype. And I think it's very important for us to like hold up a minute and just understand what's going on, because otherwise we're going to get people losing money and then they're going to be confused about, what did I have in my wallet?
Benjamin, going back to this piece again from the Stanford Blockchain Review, it's titled Type 3 Stablecoins. So I want to sort of unpack what each of these types are and what they mean. And maybe if you can sort of categorize some of the already, more prominent stablecoins into these different buckets, I think that could be helpful. So why don't we just start with what you call a Type 1 stablecoin?
Yeah, so broadly speaking, we are dividing these stablecoins by how they meet the guarantees that they're giving to users. So everybody's saying, I'm going to make yield for you, right? But then how do they make that happen? Like, who's in charge of making sure that you get yield, and who is like going to court, right, when everybody loses their money? So type 1 stablecoins are the most simple way of making yield for a stablecoin. And this is what a lot of people might call the tokenized hedge funds, where you have people that put collateral into a protocol, and then a team takes that money and does something with it. Who's in charge here of making sure you get yield? Well, it's the team, right? It's usually people with HFT backgrounds, maybe they have banking backgrounds, etc. Maybe they have vault backgrounds. And what they do is that they take your money and they do some sort of scalable strategy with it. This includes like Ethena, Level, Usual, Ondo. Even I would put all these kind of vault products like Veda, Concrete, Upshift in the same category, because all we're doing is we're making this yield product where on the front end you get to deposit, but in the back end it's just a hedge fund, right? That's not like good or bad. I think there's definitely trade-offs, right? Definitely it's more simple. So there are not a lot of smart contract risk here. And it's centralized enough to where you know that it's more of like a custody problem. So that big thing is that usually you have like 1 or 2 strategies, maybe like 3, 4 strategies, because as a rule of thumb, there's no way one team can do 100 strategies. It's just operationally, they don't scale like this. And going into like the trade-offs with it as well, they can be exposed to the changes in market conditions, right? If like we saw at the end of the last cycle, a lot of folks rushed to make T-bill stablecoins because they wanted to get yield outside of the blockchain, which is more scalable than just selling tokens. And the moment all of them started going live, crypto yields went higher than T-bill yields, right? And so none of them, like all their TVL went really down, and the crypto native stablecoins started doing better. And that's when we saw Ethena come up, right? So Ethena does the funding rate arbitrage, and they do the T-bill arbitrage. So they do 2, right? They won't be ever doing 20, right? Because it's too much. Another thing to note here, before I ramble too much, is that I personally, I'm not sure if we should have application teams acting like hedge funds, right? Because if you were a really good hedge fund, you would just start a hedge fund in TradFi, right? You wouldn't start a stablecoin. So that begs the question, are we using the skills of these DApp developers best by having them be hedge funds? I don't know. That's like an open question right now.
Benjamin, with these type 1 stablecoins, how do you think about the risk of regulation?
Yeah, I think that's the biggest hurdle for them, especially now where we have the Stable Act coming out. It's extremely restrictive to projects because understandably, the time for playing with people's money is over, right? Regulators don't want people losing money, and random coders around the world gathering billions in TVL to run hedge funds is not good, because the moment they lose money, they're going to look at regulators and say, why didn't you protect me? And so all of these custodial solutions are going to have a big hurdle to get through because they are legally holding funds on behalf of users, and they have complete agency over what happens to them. And so eventually they will have to have the same sort of KYC, KYB, and other compliance barriers that every other financial company has.
We should probably segue then into type 2 stable coins. So if you can define that, because one of the big names we're missing in DeFi that we haven't called out, I believe it falls under type 2, is Maker or Sky. So
moving forward, I guess, to like type 2, I think a lot of the shortcomings of type 2 stablecoins are solved in type 1 are solved in type 2, at least the economic issues. And this is one of my favorite stablecoins, which is Sky, or previously known as MakerDAO. Obviously, they're the kings of decentralized stablecoins. They've done this longer than anybody. And they saw this same issue that there's no way you can rely on a team to make yield. There's no way. How about instead we rely on experts like hedge funds, like T-bill operators, Centrifuge, Superstate, BlackRock, whatever, all these kind of folks. They have, I think, the right mindset here. And so in the types 2 stablecoins, who is in charge of making sure you get yield? Instead of a team, now it's some sort of a collective, whether it's a committee in the form, like kind of like Maple has it, or a DAO in the form of Sky. This is much better in my opinion, because now you're allocating to an unlimited source of yield. And so it doesn't matter what market condition you're in, Sky will have good yield because they can just move around where they put their money. Now, who's making the decision? Again, it's a DAO. And DAOs are pretty easy to corrupt. Not to fun Maker, I'm just trying to like explain very objectively. We know that when a large group of people are making decisions, yeah, it's better than if a team is making a decision, because there are a lot of the chances that they make a poor decision are lower, but you can still corrupt individuals, especially their delegates that don't have tokens, they don't have skin in the game, right? We see this a lot with lending markets deploying on L2s. It's super easy to add those delegates as advisors for your L2, and then suddenly that blue chip lending market is launching there. Or branding in general is commonplace in V token models, etc. So that's like my biggest issue with those, is that like, yeah, it's very easy to corrupt the decision makers.
Like my experience tells me that we might have started with or focused more on the type 2 last cycle. And like, did we evolve then to having more teams want to put forth these type 1 stable coins, like because of the failings of DAOs and committees of folks to make decisions? I might be like just trying to make sense of what I've seen and basically draw a line to what you just said. But does that make sense to you? Like, does it seem like we have more type 1?
Actually, I think it's the evolution. No, I think it's just like the evolution of a project. If you have moat, if you have capital, now you get to allocate it. But there's no way you start your project by saying, hey, I'm going to be a capital allocator. Not usually. Like the liquidity layer on MakerDAO works because they already have a lot of capital. So they get to like make it better. All of these new projects, like let's say like Level or something like this, they need to have like the thing that they do. And people are going to go to you because you do that thing very well, like Funding Radar for Ethena. But you already saw Ethena is already starting to decentralize. And my bet is eventually they're going to turn into a DAO model that allocates across multiple different strategies. Because look at their APR today, right? Eventually you get to a point where you have to continually allocate to external parties. And so I think the liquidity layer by Maker is like a really good solution for something like this. And everybody that is able to have moat long-term in the type 1 will eventually become a type 2 stablecoin.
I don't want to get too into the weeds on this, and I'm by no means an expert, but I do recall that some of the things that Maker was doing via this committee was allocating like in private credit. And I feel like in some instances they might have got out over their skis, because some of these deals I think were in like commercial real estate, like a liquid commercial real estate lending. And I was like, is there really internal expertise on a DeFi DAO committee to be doing some of these deals? And I think it's cool. It's interesting. I love to see that kind of experimentation, but I think, and maybe this leads us into type 3, because I think you need some sort of absolute expert kind of controlling a lot of that stuff, rather than, and I don't want to say it was somebody kind of doing it on the side off the side of their desk, but yeah, I mean, this was just me from the outside looking in and not looking at it too closely, but I was like, what is going on here?
I think they have experts. I think like MakerDAO has experts just as good as anybody in TradFi. But here's like the thing, right? Like you can be really good at allocating capital. Eventually somebody's going to lose it, right? Because if you're depositing on Ethena, if you're putting in Maker, Level, Usual, whatever, you're just giving a loan to the teams. If thinking about legally, you're giving an unsecured loan to Ethena. You're giving an unsecured loan to Maker, and then they're generating yield. And if they lose your money, you have no equity. You're a debt holder, right? And so, where type 3 stablecoins come in is what happens when things go wrong. Like, how do we ensure using smart contracts that when things go wrong, not if things go wrong, users have some sort of recourse, because things will go wrong. Like if you're lending to 100 people over 50 years, somebody's eventually going to lose money, even if you're the best allocator in the world.
And so, Benjamin, I believe CAP is what you would say the first type 3 stablecoin. Is that correct? Maybe kind of, yeah, let's use this opportunity, I guess, to break down CAP at a high level first. Maybe what is it? How is it differentiated? What's the approach?
Yeah, so like we knew that the front-facing part of all these stablecoins works very well. Redeemable reserve-backed stablecoins are the future. The age of market-based pegging like CDPs is over because people want to be able to redeem their stablecoins at any time. So that part of it is completely, solid in our industry. The problem part is on the back end, how you're generating yield. And so we talked about how it's important to have many players generating yields for you, but it's also important to not have this role of an allocator, like a human making decisions of who gets money. I wanted to make something that's more like Ethereum. Like if you want to validate on Ethereum, you don't call up Vitalik and tell him, yo, I want to be a validator. There's some rules and specifications for anybody to be a validator. And if you follow those rules that are in a smart contract, then you get to interact with Ethereum as a validator. Well, it's the same for us, right? There are these rules basically commoditizing the idea of a yield generator. And as long as you adhere to those, you get to generate yield for us. And so what that looks like in practice is that we're an AVS on EigenLayer, which is like a big fancy word, but all it means is that we have a ton of different operators, which is folks that are coming with skills, and they're all different skills, and they're willing to do a task for us. And that task is to borrow from our protocol and generate yield. And the metric that we track to see if they're generating the yield or not is if they can beat our hurdle rate. If they beat our hurdle rate, they get to keep all the money over the hurdle rate. So it's quite nice for them because there's no collateral requirements for them. But we're not rebuilding Maple, right? So on the back end, before they can come to us, part of the specifications that our smart contracts require is that somebody's vouching for them. There's some sort of like institution that's staking some ETH and say, I will back BlackRock in case they don't meet the hurdle rate, if they don't repay, etc. And that's where like the restaker operator relationship comes in, where EtherFi gets to say, I'm going to vouch for KKR, or Renzo says, I'm going to vouch for BlackRock or somebody like this. And if those people default, then they're on the hook for it. Because that's a kind of like the EigenLayer model. It's like a trust place for, a marketplace for trust. And there's a lot of like details to this, right? It's not like Renzo just trusts BlackRock. They have a legal agreement that says if they don't pay back, then BlackRock owes Renzo that money. So in a sense, Renzo and all the restakers are protected by the law. Because being institutions, they're in a very good position to enter into legal agreements with all these institutions, and they're in a good position to enforce those via legal rails. Who's not in a good position? Retail, right? Like, look at what's happening now with multi-chain. The bridge was hacked. All of the money is held by Binance, but they don't want to give it back to users. And so who's going to go up to them and try to get the money back, right? So what we do here is we say, okay, let's have the users be fully protected by the smart contracts. So like this system of people vouching for the operators. And then the people vouching are protected by the legal agreements.
This episode is brought to you by MANTLE, the ultimate Ethereum L2 for builders. With over $2.16 billion in TVL, MANTLE powers multi-billion-dollar yield-bearing assets like CMETH and FBTC, driving sustainable growth and capital efficiency. Plus, MANTLE offers a unique reward station for airdropping different tokens to MNT holders, including one ongoing campaign for 4 million Ethena tokens and another for 570,000 Eigen. To learn more, go to mantle.xyz, and thanks to Mantle for supporting us at the Edge Podcast and Edge newsletter. Okay, I want to make sure that the audience is following all of this. So CAP creates a protocol that's centered around rules that allow us to deposit stable coins, and then that pool of stable coins in some way is ultimately being lent out to really highly skilled yield generators. And I'm calling a yield generator would be in my example here is someone who would be a high frequency trading desk or a DeFi focused trading firm someone who is going to specialize in generating the yield, they're able to, let's say, borrow they're able to borrow from that stablecoin pool. You mentioned a hurdle rate, meaning some sort of like benchmark rate that they have to beat. And if they beat that, I'm assuming then the yield is distributed to different folks that are participating in CAP, but then they obviously are able to take like that excess from it.
I think what we can do is like take a look at the lifespan of a dollar within the system. So it's a three-sided market, right? You have restakers their money is locked on Ethereum on the beacon chain, and it's no opportunity. Like you can't do much with it. Or you're a Bitcoin holder, you can't do much with Bitcoin, right? Because there's not a lot to do with it, especially when you compare with USD. USD has everything that you can do with it. And so these folks come to EigenLayer and say, look, I want to make some money, and I'm willing to vouch for reputable firms. I'm not talking about crypto market makers. I'm not talking about degens. We're talking here about large financial institutions, and they have in fact already signed up to be our operators. So these are the folks that they're vouching for. In exchange for that, they get to charge a fixed yield to these folks in the form of a delegation premium. And this is how we break from other AVSs. I don't want to get too much into the weeds of it, but I will say between the restakers and the operators, they come to an agreement and they say, look, Wintermute, I'm going to charge you 5% because you're a crypto market maker, but hey, BlackRock, I'm only going to charge you 2% because you're like a regulated entity. And these are like person to person, like this is a marketplace. It's called EigenLayer, and that's where they do that. Afterwards, and that's like part of the cost to the operator when they borrow. It's this hurdle rate that they're paying, this premium that they're paying to restakers. Then they come to us and they try to borrow. And so then we have to decide, how do we make sure that we're charging enough to compensate the stablecoin holders that have deposited money into this protocol? Well, the folks that are depositing money into this protocol want to earn yield, the best yield in crypto, but they don't want to be exposed to the risk of the operators. And they know they're not, because they know that anybody that's going to borrow funds from CAP has to first be covered by the restaker. And so you essentially have the same risk profile as using Aave, but then the yield is much higher. So getting into how we calculate the yield, the minimum yield that you will ever earn is what you earn on Aave as a depositor, because our interest rate calculation has a minimum function of the deposit rate at Aave. Based on utilization, then we give a premium on top of that. So you can imagine the minimum in the curve is the Aave deposit rate, and then based on utilization, we start increasing the amount that's paid. Why do we do that? Well, if every operator is borrowing, clearly the hurdle rate is not high enough. If no operator is borrowing, clearly the borrow rate is not low enough. But here's another interesting part to it. We don't want to have human input. We don't want to say, okay, so this is the kink rate, this is the slope, we have to increase it, we have to decrease it. So we're using Morpho's IRM to basically calculate the utilization premium. Because if you're familiar with it, basically you don't have to choose anything. You don't have to choose the slope, you don't have to choose the kink rate. It completely changes the slope based on stresses. If you're too much on the 99% utilization, if you're too much like low, then the whole slope can change based on those stresses, and you arrive at the natural interest rate that you're supposed to have.
One question, and like this is going to be very hard to answer for you, but what sort of benchmark rates do you foresee? Obviously, it's going to be market dependent, and feel free to give a range because, it's probably jumping all around, but just trying to like get an idea, because DeFi users in general, I think they swarm to obviously high yields, right? Especially something that can be consistent. And then you've used the word guarantees a lot, and that keeps running through my head. So something I'm picturing that is maybe safe and consistent, I think has a lot of value in DeFi. But what can you kind of project right now?
Yeah, so let's talk about ranges. So if you're using a lot of the type 1 stablecoins, what is the range of yield you can get? Well, the upside is practically unlimited, as good as these hedge funds can be. The downside is 100%, right? If like one of these custodians that they use, if one of the vaults that they use goes bankrupt, they get hacked, whatever, you lose 100% of your money. So that's like the range that you have. Same with type 2 stablecoins, right? You can earn unlimited amount upside, but also unlimited downside. If, Sky delegates to some random, I don't know, some like T-bill person and they go bankrupt, you lost that money. There's no recourse for you. Unless the DAO is willing to cover the hole, but those are not guarantees. That's just like a hope. For us, what's your downside? Well, your downside is, 0%, right? Because, not 0%. Your downside is how much you can make at Aave. Because your principal plus the Aave rate are guaranteed by slashing conditions. And so in the event that something happens to your capital or your yield, we can slash somebody. And so I can actually tell you that there's a guarantee that you will get that unless EigenLayer gets hacked. Let's hope that doesn't happen. Now, what's your upside? Well, your upside is how competitive the yield markets can be for CAC, for this unsecured credit. Now, if we were to launch the stablecoin today, I can actually tell you what probably is going to be the yield, because we know that the total unsecured credit line premium for crypto native or crypto adjacent entities is between 10 and 12%. They're comfortable borrowing at this amount. So the hurdle rate for the stablecoin plus the restaking premiums should be no more than 10 to 12% if we were to launch today. Well, what should be the premium for the restakers? It's pretty easy. You look at a default risk premium, which is the chances you default plus the market premium, or you can call that the opportunity cost. The opportunity cost for delegations is 0.66% today. And the chances that you default is just the chances somebody defaults. So like Susquehanna, they're a $600 billion HFT firm. They're going to be one of our first operators. What are the chances they go bankrupt and they don't live up to the legal agreements that they signed with our restaker? We can safely say it's under 1%. But let's say 1% to make it super simple for the math. And let's say the opportunity cost is 0.66. So the premium is 1.66% on the funds at risk, which is the loan value. It's not the value of the ETH. But let's double it, because let's say, Susquehanna is feeling really nice. So we're paying 3% premium to the risk takers on the value of the loan. Well, that leaves you with anywhere from 7% on the low end up to 9% on the high. So 7 to 9% that's left that we can give to the stablecoin holder. If I remember correctly from this morning when I was checking Aave is like 2 to 3% APR, and we would be giving 7 to 9%. And I can say that it's the same economic guarantees because from the point of view of the stablecoin holder, it's over collateralized lending. We don't need to give 30, 40, 50, 60% APR because we're not like the type 1 stablecoins, right? We can guarantee the safety of your principal. So as long as we're giving meaningful yield above Aave, we're in a really good position. And I think right now, 6, 7, 8% APR on the dollar is kind of like covered and it's made by these large financial institutions. It's a very good, value prop for capital deployers.
Something you just said. So do you consider what you're building, this type 3 stablecoin, like, is this in the spectrum of risk? If we were like comparing type 1, type 2, and type 3, like, can you rank those? Like, which one of those is the riskiest? Is it the type 1 that is, and then this is closer to like type 2?
Yeah, I think type 1 is, type 1 and type 2 have a similar risk because what do you trust more? A DAO allocating to different things or a team that tells you, for sure, we're only going to do these strategies? So like, it's kind of like a give or take. You need to make that decision. I would consider all of those closer to like a BlockFi or like a Abra. Like you're under collateralized lending to an entity and you have no recourse and you're just letting them make yield for you. I think we're closer to the risk of Aave because from the point of view of the user, it's over collateralized lending.
Benjamin, something else. So we've been talking about EigenLayer, and to my knowledge, slashing isn't live yet. Correct me if I'm wrong, but I believe it's live on their testnet. So is that an integral component for you to go live? Do you have like other options that you're building on top of, or where are you at with that?
Yeah, I think Eigen is very early days right now in terms of like a lot of things, right? They're doing something that's huge. In my opinion, the only scalable use cases for L1 tokens is restaking to some extent. Basically, the idea of taking a token that does not have a lot of opportunity and using it to vouch for people doing things. And those things can be validating off-chain data. It can be processing ZK proofs. And in our case, it's generating yield. Now, yeah, I mean, I wish it was faster, to be honest, but it's coming. And EigenLayer has committed a lot of internal resources to making sure that what we're working towards is compatible with them. And slashing will be live by the time we launch. Slashing and redistribution. So not just slashing and sending it to address 0, but slashing it and using it to send it to whoever was hurt. And also, yeah, it's probably important to note that we're also building on SYMBIOTIC. So we're a SYMBIOTIC and EigenLayer. And if you're an operator, you can get delegations from either or both of them. And our plan is to continue expanding. We want to be on all shared security markets because there's a lot of L1 tokens like Bitcoin, for example, Babylon, or Sol with Cheeto. There are a lot of these L1 tokens that have no opportunity cost, and they're amazing source of, delegations for our protocol.
Can we talk about like worst case scenario? Just like as a user, this is what I'm always concerned about is like, what if there's an exploit that affects one of the operators that's generating yield? So like, let's say it's, did you say Susquehanna? Is that one of the folks? So, okay, so Susquehanna has an incredible reputation. They, I'm not concerned about them like running off with stablecoin funds, anything like that. But what does an operator like that do if they are, let's say they're working with $1 billion of stablecoins from the pool? CAP has become one of the biggest protocols in DeFi, and a part of their yield generation strategy relies on a protocol, and that one gets completely drained somehow. Like, again, I'm thinking just absolute worst case scenarios.
No, this stuff will happen, right? Like, last cycle we thought like, oh, there's like X and Y custodian and they're the best in the world. They collapsed. FTX was the largest donator to like one of the America's presidents, and they collapsed. So like, there's no such thing as a Lindy anything. And this goes back to our thesis that you don't trust anybody. And I can't believe we forgot about that in DeFi with like trusting these custodians and believing that that's okay. So I think anybody that uses a custodian will eventually blow up just because that's the way things go. And so what happens in our case? Well, let's look at the three-sided market. If you're a stablecoin holder, you don't care, right? You don't really care because we can slash somebody, you get your money back, GG, just like if you were using Avid. If you're a restaker, what happens? Well, you are a large institution, right? You're not just some random person because we only allow delegations of large values to make sure that these are companies, not just random people. And so you have a master loan agreement or some sort of a loan agreement with the operator. And so if these people lose your money, okay, it's bad, right? But it's not the end of the world because they legally have to pay that money back. They have a legal contract with you. And we're not signing legal agreements with random DeFi native hedge funds, right? We're signing legal agreements with the largest financial companies in the world, right? And so the chances they go bankrupt, pretty difficult, right? And so, yeah, it's a pain in the ass, but you'll eventually get your money back. This is from the restaker. If you're the operator, well, you don't owe anything to CAP because CAP doesn't trust you. CAP will slash you. CAP doesn't care what you think about it. They don't look at what your name is. They just look at your delegated stake. So who do you owe something to? Well, you owe something to the restaker. You have a legal agreement with them. And so you have a fiduciary duty to not just play around with the money. And if you lose it, it's on you. You have a legal agreement with them. That's part of like the whole thing here. And so, yeah, you'll have to like eventually cough up the money. And so that's just part of having a loan agreement.
Benjamin, I'm back to this Susquehanna thing because I'm fascinated as to what they see in this arrangement that they can get in DeFi that they can't get with their traditional lines of credit and things like that already in their world where they operate. So what is the incentive to come into this system for them? Like, why is it better?
No, it's crazy. I mean, when we first launched this, we thought it would be like crypto market makers because you've seen a lot of the projects that do lending to crypto market makers. We'll name them because I don't want to seem like I'm fighting anyone. But like a lot of people are doing that. We've been able to actually get the world's largest financial institutions, which is insane to even to say out loud. And so why are they doing it? Well, all of these financial institutions, want to enter the blockchain to access new sources of capital, because they know that the future customer, the marginal customer, is going to be international and they're going to be on-chain. This is the new finance, right? And the way that a lot of people are going about it is that they're tokenizing their products on-chain. That's fine and all, but that's super expensive. Like, let's say Apollo puts $200 million of their private credit fund tokenized on-chain, and somebody wants to buy all of it. Who's going to market make that? Who's going to hold that in the inventory long enough for somebody to buy it? What's the slippage going to look like? And so it's like very complicated kind of structures. It's almost easier for somebody just directly to buy it on the TradFi rails. What do I tell them? I say, well, look, you can borrow from us just like you would from Aave. And you can borrow from anyone. I mean, you're borrowing from a family office in Bangkok. You're borrowing from, somebody in like Europe. And obviously, we're blocking OFAC and all those kind of people. And we have the ability to do that at smart contract level. But now you get to access capital from people all across the world who are comfortable dealing with you, not because they trust regulators, but because they trust the smart contracts to protect them. Because let's face it, if you're a family office in Bangkok, how much can you trust American regulators to protect you? The way globalization is going, I wouldn't bet on it, right? And so now you're comfortable doing this way more than you're comfortable buying your tokenized products, because you have zero protection buying the tokenized product. And so that's kind of how I'm selling it to a lot of these TradFi institutions. And they said, look, if my TradFi product earns more yield than the cost to borrow, why wouldn't I borrow as much as possible, beef up my AUM, and now I'm earning fees on more money? And by the way, I expanded my my clientele to different parts of the globe.
Okay, I thought that was my last question on the operators, but again, I find this like really interesting, just how you're even talking to these people, and then like how you're choosing them finally. Like what is your criteria that's like, oh yeah, you guys will be great at this? And then is that something that will take constant curation by a human kind of in that loop to pick and choose these operators?
Yeah, so here's like the thing that I don't like about DeFi today. It's, who's choosing, who's making the decision, and what's their downside, right? Like in type 2 stablecoins, it's a delegate, and their downside is, their salary, or it's a token holder, and their downside is the token value. But oftentimes, there's like a multiplier between how much money you're dealing with and how much your downside is. Even a team, like if your token's worth $1 billion and your TVL is $5 billion, do you really have an incentive to make a good decision? Well, if you make a bad decision on $3 billion, you can lose all your tokens, which is maybe 10% of the supply of the FTV, because that's how much the team has. Those incentives are not mathematically aligned. With type 3 stablecoins, who makes the decisions? It's not me. It's not like any like rating agency. It's the restaker themselves. And they say, I vouch you, and so now you can come and borrow from CAP. If EtherFi thinks you're kind of not that safe, so they only delegate $10 million, you're not borrowing $15 million, right? And if they make a bad decision, they're on the hook for 100% of their decision. It's not like it's a partial thing. And I think this will lead to the safest outcome. Because if you're on the hook for the decision that you make, you're going to make a safer decision. Because let me tell you a secret about restakers. They don't want to get slashed. And so they would rather go with somebody that's safe with lower yield than some degen person with insane 50% APR.
Benjamin, DeFi Dad and I have a little document that we kind of go back and forth in on the side here. And I was just writing to him, if this works, I feel like it could be a big moment for EigenLayer and, even restakers like EtherFi, because they're definitely yearning for a breakthrough app to kind of showcase what the system can do and how it works. It's all been very abstract for, users or just people on the outside listening to words like intersubjective token. But for somebody to come to the arena and showcase and have it all work, I think would be massive. So maybe from that, can you kind of just maybe riff on a bit just the importance of restakers in this relationship as well?
Yeah, I think this is a very important next step in EigenLayer, shared security, even SYMBIOTIC, because when I first read the white paper for EigenLayer, I saw trust marketplace. I saw people that have staked ETH that they can't do anything with, and now we're rehypothecating that value. So it's extremely capital efficient. and we're using it to underwrite the risk of something else. And this is very important for a one tokens, right? Because it makes them money. And on the other side, I saw this operator role where you can do things and we can ensure that those things will happen because you can slash somebody if those things don't happen. And then I actually saw the implementation of AVSs and I thought, wait, hold up. Why are we all focusing on validating off-chain data, right? The problem with validating off-chain data is that you need to passively pay people to validate the state of a network. And that happens whether there is a transaction or whether there's not a transaction. But this is not an L1. You can't just mint your token constantly to pay validators, right? The idea with Eigen is that we don't keep making more tokens. Instead, we use the existing tokens to underwrite the value. But then how do you mix and match? You have this need to passively reward people, but then you can't mint ETH, right? And so what happens with a lot of AVSs, they say, well, let's just mint our token. And so they're just minting governance tokens to reward the restakers. The restakers don't want your governance tokens, right? They want more ETH or they want more Bitcoin. They want whatever they came with. And at scale, if we're talking about $10 billion, $20 billion of shared security, which we will eventually need, there's no way that you're doing this with a governance token. And so what then we came up with is this idea of the productivity-based incentives. Let's allow the operator role to do anything they want to do, well, anything that AVSs can have a role for you to do, and only pay them when they make value to the system. And because of that, because you're tying the value generation to this paying the operator, you never have to have inflationary tokenomics, right? The liabilities, assets, they always line up. And so that's kind of like a big thing that we're changing. And to be honest, like the Eigen people were like, wait, I didn't know you could do this on EigenLayer. But trust me, I've been talking to them for over a year about this. And they assure me that it works. And in fact, they're even introducing some updates and helping us make sure that there are no compatibility issues. Yeah, I mean, to sum it up, I just think people were really narrow scope about the possibilities on top of EigenLayer. I think this is much bigger than was initially thought.
I think you're illustrating a great example where EigenLayer is allowing folks to pool money, and that money in the form of ETH and other tokens as well ultimately can be used to bet on all sorts of different like outcomes. Normally they're the outcomes that like nobody wants to happen, of course. Like, you know, they're ultimately almost like, I still think of EigenLayer a bit like insurance. I still think of it like a mega insurance pool.
It's a dirty word, and I will never repeat it, but you can say it. But like, that's what it is. It's called the trust marketplace. I mean, come on. It's like, it's what it is. And there's roughly like three main kind of ways that I think EigenLayer AVSs will eventually be. One is like the way they've been, which is like all the operators are doing the same thing and they're doing it passively. And because they're doing it passively, they can't pay enough money to them. And so they're going to need to give them token emissions. The other one is where you have each operator doing different things and they're active and you're paying them only based on what they do, if they're doing good things or they're doing bad things. And then the third one is not having counterparties at all, where basically you can have the risk takers underwrite the risk of anything happening, of like tomorrow it's going to be sunny, or maybe a stablecoin is going to be pegged. We've seen a lot of these type of insurance protocols come out. Frankly speaking, I think that last is pretty risky. I would much rather sign a contract with BlackRock and have my risk of being slashed BlackRock not doing their thing because I can quantify that than saying a stablecoin depegs. Because then it's like, okay, a stablecoin can depeg based on many reasons and you might not know these reasons. So I think that's like the future of Eigen. There's going to be those three broad types of AVSs.
So to bring this back to the user, in the future, when CAP is fully live, let's say that I mint some cUSD. Do I have to stake it then in order to capture the yield? How does the yield accrue to it? Like, how often does it accrue? And is it a rebasing token where I'll see the amount of the token tick upwards in my wallet, or does the actual token just accrue a premium that, you know, I could like trade out of it at some point?
Yeah, so everybody accrues their yield constantly. And this is amazing for risk takers they can call update fee as much as they're willing to pay the gas for it. And what that does, it gives them cUSD, cUSD, which is their stablecoin. And they can redeem it for USDC, USDT, and pay that to their users. The biggest LP in the world, right? It's ETH USDC, so it's super easy for them to compound it and have real yield for their restakers. For the stablecoin holders, it's the same. I think we're borrowing from Euler, the fee auction mechanism. So like people can call it, and it's all autonomous. We're not relying on any bots. There's no Web2 infra. 100% of this project is completely on chain and relies on economic incentives for people to run it. So like we can disappear tomorrow and it still functions. A little bit of a tangent, but yeah, the stablecoin holders, they stake it just like you have DAI and SDAI or USDE and SUSDE. Anybody in the world can come and mint it, redeem it. You can stake it or not. Some people might want to have the pegged version for integrations. Some people might want the interest-bearing version.
Hey folks, I want to tell you about our sponsor GEARBOX, the protocol that reimagines on-chain lending. With GEARBOX, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about GEARBOX, go to gearbox.fi.
Egg, a quite astonishing commodity. The cause of your desire. Egg, which fills the inner void. Egg.
Eggs are pretty epic, but you know what's more epic? Paying for them with crypto. Borrow, earn, and now pay with MOONWELL.
Say hello to Puffer Unify. Puffer Finance is expanding beyond native liquid restaking with new products such as Unify-based rollup and Unify Pre-Confirmations AVS. Unify is not just another L2. Unify is a based rollup, one that will solve L2 issues, such as slow withdrawals versus instant withdrawals with Puffer Unify. Puffer Unify is fast, capable of sub-second transactions. Unify also has boosted Puffer points, which means if you bridge assets, you earn boosted Puffer points and rewards from dApps on Unify. Puffer's core products mean a bright future for Ethereum. Learn more at puffer.fi.
Benjamin, I have two questions for you. First, why build on MegaETH? And second, what does CAP mean? Why'd you call it CAP?
Yeah, so first of all, we're deploying on Ethereum because we need to be on the same chain as EigenLayer and SYMBIOTIC, because otherwise you're slashing across chains and you're going to get hacked. I mean, no question about it. So we're trying this modular approach, and there will be a lot of automation so that people can natively mint it from MegaETH without really having to worry about the gas or anything like this. Now, why MegaETH? There's like two parts to it, the tech and the people. I build on most chains than most people, right? And so has my team. So we have the CTO and the dev team at Beefy Finance. We have ex-marketing lead for Frags. Between both, all three of us, we're the most cross-chain projects ever. And so we can tell you what a chain that's going to make it looks like and what a chain that's not going to make it looks like. And MegaETH has got that. I think a lot of chains right now are grifts or just like VC plays. I think that the people that are working at MegaETH don't know how to lose. I don't think Shuyao knows how to lose. And she's very smart. And she's somebody that I want to work with. Namek, Amir, these are people of very high quality, and I can compare it to the other chains that I've been on. And I know that it's a good ecosystem to build on. So that's from the people side. On the tech side, they're unlocking a new set of applications. It's not the copy pasta that you've seen on every other chain. Every application that's launching on MegaETH is completely novel. And I think that's something that's really interesting. And also, by the way, they're all using our stablecoin. So it's quite nice. And so we've become kind of like the ecosystem stablecoin for these batch of like completely novel applications. So that's like extremely exciting for us. Yeah, maybe I'll pause there because there's like a lot to do that, a lot within that.
Yeah, no, that was great. And yeah, we were talking a bit offline about the name CAP, and it kind of struck me that there was more behind it. And to be honest, I forget the words that you used, but maybe that's why you simplified it to CAP. What does CAP stand for?
Yeah, so the title of my research into this project was Covered Agent Protocol. Covered comes from the fact that all of the activities being done in the protocol are covered by delegations. And then agent is because instead of using operators that are passively participating in a system, they have agency over how they complete the task at hand, right? If you're generating yield, there's many ways that you can do it. And so if you have agency, then you're an agent. And then protocol, because we're not an application, we're a protocol, almost like a blockchain, where there's like these immutable rules that people have to follow. The thing is, like, a lot of people will see agents and think AI, but it's an academic term. It's not just like for AIs. And so that's why we shorten it to CAP, which has a lot of funny implications, because a lot of people, they say cap, no cap. There's a lot of like meme factor there.
One of the takeaways for me today, because I was thinking going into this conversation, like Ethena is Ethena, Maker is Maker, Cap is Cap. But it feels like what you built could be a very symbiotic relationship if you were to be able to convince or attract a team like Ethena or Maker or others to come on board and be an operator within CAP. So how do you think about that? Like, is that sort of like a working relationship possible in the future between these protocols?
Yeah, I've been talking to both Maker and Ethena for many months now about this, because the way that I see CAP at maturity is almost like a universal marketplace for liquidity, where Ethena, Maker, Level, whoever it may be, can participate in competing for capital in the same marketplace as KKR, BlackRock, Susquehanna. Because I do believe that these applications will be the future financial institutions alongside the ones that we currently have today. And it's done in a way where users are ultimately always protected from this marketplace. So the marketplace can happen and the users are protected. And nobody's exposed to the risk of one particular kind of like operator. Every operator is siloed to whoever is vouching for them. And actually, you see that today with the Type 2 stablecoins leveraging the Type 1 stablecoins. Like Maker uses Centrifuge, Maker uses Ethena. But there is one issue there that now if you're using Ethena, your risk is the same as using Maker, because they're putting all this stuff into SUSDS. Well, using Maker, your risk is Ethena because they're putting all this stuff in Ethena. And so there's like a concern that if one of them blows up, there's kind of like a cascading effect on everybody else. In this scenario, we are able to bring everybody on board as an operator, while making sure that no one person, no one player in this entire ecosystem is exposed to the risk of everybody. And surely the retail is never exposed to the risk at all of any of these operators.
Benjamin, when we deposit or like mint cUSD, so we deposit stable coins, like what happens to that idle capital before it goes into some sort of yield generating strategy?
One thing I didn't say is that we are essentially an extension of Aave, because we deposit a lot of our our idle capital. When you deposit into CAP, it all goes to a selected base yield strategy that sets the risk-free rate for CAP. And for us, the risk-free rate is Aave. And so all of the USDC, all of the USDT via a Yearn vault, immediately our own Yearn vault, not like at Yearn, all goes into Aave. And to the extent that the operators are able to beat the Aave rate, that's when they can borrow. And that's why in our interest rate calculator, the minimum is the Aave rate, and then there's a utilization premium. So even if, let's say, nobody delegates, nobody borrows, you're at least earning the Aave rate.
One of my worries is that as DeFi continues to grow, like all of the opportunities they're very difficult to keep up with. And it's only because like I've had the benefit of being early enough to kind of like know all the different applications, know all the major yields. We do our best week to week to try to like highlight and curate yields through the Edge newsletter. But this is the opportunity that you're building for CAP, like to be able to create like a coordination protocol that allows someone to just hold something like cUSD and then benefit from all these different major players earning stablecoin yields and being incentivized to, be good actors, but also having this like fallback with something like EigenLayer and SYMBIOTIC backing it. It's really wild. Also, the timing of this, not knowing exactly when you will go live, which is probably our final question here for you. The timing of this is insane because there's been a very like loud developing narrative, I think around crypto Twitter across the whole industry, that stable coins like have been completely underestimated for how bullish everyone has been around their product market fit. And now with like a new, regime in charge in the United States that's more friendly with like friendly regulation coming for stable coins, like people are just realizing that there is a lot of money to be made there. And the biggest question that's been asked lately is, how do I bet on stable coins growing? Like, where can I like make a bet and accrue value? It's something that's being debated like every day on crypto Twitter.
We're not there. Like for all these applications, for most of the time, we're not even bidding T-bill rates. So it's like there's clearly a problem that has not been solved.
I have personally put some money into Aave, for example. And part of the reason I'm happy earning like 2.5% there, even though it doesn't even beat the T-bill yield, is I like the control that I have and I like the safety and security of it. But if you told me that I had an alternative path that was as secure and as much of a guarantee that I can get my money back instantly, I'd absolutely turn to it. I guess Fluid has been another one as well that we're really happy earning yield in. But one thing I just left out, one of the ways to potentially get exposure to the stablecoin like growth in DeFi could be CAP. Like I recognize it could be as simple as just cUSD, which, will be a great yield to be able to earn. But I'm also thinking about the value accrual behind whatever CAP token comes in the future. So I don't know if you can share anything on that. Are we able to talk at all about a CAP token, or just like what would value accrual look like for CAP, the protocol?
Yeah, I think from a technical point of view, as like developing the protocol, there's going to be very little governance, if any governance at all, because we don't want this to be a DAO, right? We want this to be Ethereum. We want this to be Bitcoin. And that means rules, and that doesn't mean politics. There will probably be some sort of like buyback and burn mechanism using the fees from the protocol, because the protocol takes a percentage of the yield that goes to the stablecoin holder. And so that's probably going to be where most of the value is generated for the protocol.
Very cool. Well, guys, I think this is a good place for us to start to wrap up. So I want to remind our audience they can learn more about CAP by going to cap.app. They can also follow capmoney_, which is the handle on X. Follow Benjamin918_. That's his personal handle, and you can see some of the updates there, as well as some of the interesting like posts and takes that Benjamin has there. And then we'll put that all into our show notes so you can easily find that. And then for one final question to close us out, would love to know if you can share like when CAP might go live on mainnet. And otherwise, Benjamin, just thanks so much for your time. This was wonderful. This is so interesting. I definitely recognize parallels to the excitement of like when we were first talking with EigenLayer, and I think that was like early 2024 there before they went live. Maybe it was early 2023. Yeah, way before they went live. And then Morpho, I remember talking to Morpho, and I was like doubting like, how can you improve on what like an Aave's already doing, or like what Maker has accomplished? And so stablecoin markets are thriving. It's the killer app in DeFi. And I had a similar sort of like response to like learning about CAP, like what else is there to improve here? And I think if you've listened carefully to this conversation, you should come away realizing there's massive room to improve the efficiency on this market?
It's so much. I mean, you look at the people in our team is Frax, Beefy, and Cheeto. We've been in this space for a while, so we're in a position to know where the holes lie, like where the gaps are.
Totally agree, Benjamin. And so, yeah, when can we expect that CAP will go live on MegaETH mainnet?
Yeah, so, I mean, right now we've passed 2 audits already, Trilobits and Delic. We're going to do another one just in case with Spearbit. So we'll be ready to launch in May if we want to. I think we'll want to align our timelines with MegaETH as much as possible. We're deployed on Ethereum, right? But we're really focused on MegaETH because we really think that's where a lot of the usage of CAP is going to be. And so it may be that we, release the protocol a little bit before, but then issue the tokens on MegaETH when we launch. It's unclear. It's mostly up to MegaETH when they go to mainnet. But they're already in public testnet, and the only feedback I've gotten about it is that it's fast. So things are going well so far.
Thanks everyone for tuning in. If you're a talented founder or developer, please consider reaching out to our team at fourthrevolution.capital. And to stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.